This presentation is called The Fed Does Not Exist, and it's a companion or introduction to the book with the same name. And the goal is to really deeply understand what all actually is in the Fed's toolkit and what isn't, and how the Fed is or isn't able to actually influence economic conditions. So hopefully by the end, we can recognize that there doesn't actually exist an independent entity that can manage economic conditions like we think the Fed is able to. So at a high level, there's sort of two pieces. First, that the Fed doesn't get a free lunch, just like you or I don't get a free lunch. And what I mean by that is that the Fed doesn't have the ability to magically just add returns to the system or destroy risk from the system. And the reason for this is that the interest rate that the Fed sets isn't what we pay out of the system into some sort of black box. It's the rate that we're paying each other. So when you reduce that rate with the intent of stimulating the economy, it reduces the cost of capital for some players, but by reducing the income from interest for another player, it raises their cost of capital because income and profits are what determine the cost of capital. And then the second point is that based on this idea, the Fed cannot destroy risk. It can only shift who is holding the burden of the risk, whether that's between players or through time. And if we take the kind of Markowitz idea that the only free lunch out there is diversification, then the only way that the Fed can give the system a free lunch is by redistributing that risk in a way that diversifies that risk. And we'll get into what this means. So on the first piece of that, which is the interest rates part, interest rates are like any price. So if you lower the price of something, then the person who's selling that thing will stand to make less. And that's because one person's spending is another person's income. And spending on interest is no different. So if everyone is borrowing at low rates, then everyone is also lending at low rates, which means that everyone is earning low rates. And as income falls, spending falls. And then the second piece was diversification. And here we introduced the idea of complements and substitutes. So this is kind of like an Econ 101 way to describe how two things can interact. So two things can either be complements, which are items that make sense to hold together, like a printer and ink, or substitutes, which are items that make sense to hold instead of each other, like two types of printers. So with complements, as the price of one item goes down, the attractiveness of that two-item pair goes up, which causes the price of the second item to go up. And then with substitutes, if the price of one item goes up, the attractiveness of the other substitute goes up, which causes the price of that item to go up. So this is sort of like a way to visualize using a seesaw how substitutes and complements can interact with each other. So if we have an item A, then as the price of that item goes up, item A is on the left side, as the price of that item goes up, the price of substitutes for that item go up, but the price of complements to item A go down. And this seesaw will be useful shortly. So here we have an example that I think kind of demonstrates this. So the thing to recognize here is that if an item's complement is expensive, then I can hold fewer of that item because that means that the pair itself is now more expensive. So in this example, let's say that I have $100 and I have two items, phones and phone cases, which are perfect complements, which means that I need one in order to have the other. I need them together. And let's say they each cost $1. Then the optimal allocation would obviously be to split the $100 equally, 50-50. But now let's say that cases cost $3. So the phone case pair now costs $4. Then the new optimal allocation would be to only have 25 of these pairs because we have to dedicate $75 to the cases. And on the other hand, if we kind of reduce the total price of that phone case pair, so instead of $1 each, now let's say cases cost 50 cents, then I can buy 66 phones and 66 cases because the cost of the two-item phone case pair has fallen. So we can actually apply this logic to assets too, which we can also treat as either complements or substitutes. So as an example of this, an example of complements would be like ExxonMobil stock and a treasury bond. And the reason for this is that the properties of these two assets are so different that they help the portfolio of these two assets cover a larger range of possibilities. Whereas if I had a portfolio of just Exxon stock and Chevron stock, which are closer substitutes, then I'm not really covering as large of a range of possibilities in my portfolio. So we can kind of take this and look at another kind of numerical example. So let's say we have two assets, which we can see are complements because kind of similar to the Exxon and Treasury bond example, assets A and B in this case, they pay out in entirely different scenarios. So asset A pays $1 on heads, but it loses 50 cents on tails. And then asset B pays $1 on tails, but loses 50 cents on heads. So if I had $300 and I wanted to allocate to these two assets in the optimal way, I should obviously split them equally, assuming that I don't have a view on whether I'm going to flip a heads or a tails. And if we look at kind of the table of these different allocations and their outcomes, we can see that splitting the $300 equally gives us the ideal outcome because the expected winnings is $75 and there's no volatility, there's no standard deviation. So the kind of risk adjusted return is actually infinite, or the Sharpe ratio in this case is infinite. But now let's make one change where now asset A only pays 50 cents on heads instead of $1 on heads. And let's see what the optimal allocation would now be. So the interesting thing here is that the optimal allocation actually depends on what your priorities are. So if your goal is to still kind of maximize the Sharpe ratio or the risk-adjusted return of your portfolio, then you actually have to increase your holdings of the lower returning asset, which in this case is asset A, in order to maintain equal kind of payouts from a heads or tail outcome. But if you're trying to actually just maximize your expected return, for example, the optimal allocation would then be this bottom row, which is to put $0 into asset A and all of your money into asset B, and then just hope that you flip the tails, because asset B is paying out more on tails than asset A is paying out on heads. But the problem here is that if you have any sort of constraint on your volatility or your maximum like acceptable loss, then you couldn't afford, a higher volatility or a higher loss. Then you wouldn't be able to kind of allocate to this 0-300 allocation, because in this case, you stand to lose a lot if you flip a heads, and that makes your volatility of your portfolio kind of high. So the key thing here to recognize is that by making the payout from one of the assets worse, you've actually just made the entire range of possibilities for your allocation of $300 worse as well. So now let's try to take this into the real world. So how do we determine if two kind of actual real world assets are substitutes or complements? So the answer is that it depends on the exposures of each asset. And so the three main drivers of return are growth, inflation, and liquidity. So typically when we look at the risk curve, which is this chart on the left, it has, all of its assets with their expected returns and risks. And it makes sense that, assets with higher risk should also pay a higher return. But we can actually break up these assets into their respective drivers where they can actually sit on different spots. So quickly on liquidity, by liquidity, I mean the supply of all marketable assets that have an observable price and can be sold for cash, not just all, cash or cash-like assets, such that, when liquidity is rising, that means that the supply of all marketable assets is rising, in which case you don't want to be already holding those assets because now those assets are competing with a larger set of assets. And then when liquidity is falling, the supply of all marketable assets is falling, in which case, if you're already holding on to some of those remaining assets, then you're in good shape. So this notion of liquidity kind of goes against the typical idea of like, oh, the Fed adds liquidity by printing money, which has all sorts of problems with it. And I describe this more in the book. But the big point here is that it doesn't make any sense to call liquidity just the supply of cash and cash-like assets, because when that supply is rising, it's actually an indicator that things are getting worse. But you would obviously want to think that rising liquidity is a good thing. And I explain why rising, Fed liquidity or rising cash liquidity is an undesirable thing for the economy later on in this presentation. So now if we take these kind of three dimensions and put them in sort of like a crude XYZ graph, we can see that every asset sits somewhere in the space, but some assets are actually further away from each other than others. So we take bonds, for example, government bonds. Bonds are sort of like the ultimate falling inflation, falling growth, falling liquidity asset, because when those things are falling, you want to be holding an asset that pays you kind of a fixed cash flow no matter what. But bank loans, on the other hand, are almost as far away from bonds in terms of their return profile as possible, because they have a completely different set of exposures. And so this actually makes bonds and bank loans good complements, because if you hold a portfolio with both of these, your portfolio is now covering a larger range of possibilities. Whereas let's say if you had a portfolio of government bonds and corporate bonds, that portfolio is more kind of holding two substitutes because those two assets cover more of a similar range of possibilities. So going back to the phones and cases example, if we kind of plop these two items on our seesaw, because they're complements, they sit on opposite sides of the seesaw. So if you wanted to raise the price of phones, which is on the right side, but you could only change the price of cases, which is on the left side, what you should do is lower the price of cases, which will raise the attractiveness of the phone case pair, which will end up raising the price of phones. So now if we apply this to assets, we can similarly put bonds and loans on opposite sides of the seesaw because of their complementarity, which means that if we wanted to raise the value of loans on the right side, but we could only, change the price of bonds on the left side, we would actually have to reduce the price of bonds, which would raise the attractiveness of each bond bank loan pair, which would raise the price of loans in the same kind of logic. So this is where it actually starts to get interesting, in my opinion, because if we take the idea that price and yield for any asset are inverse to each other, then if we wanted to reduce the yield or the interest rate on a bank loan, meaning move the right side down in this case, then the way to do that would actually be to raise the interest rate or the yield on a bond. And so this sounds counterintuitive, but if we go back to the first principle we talked about, which is that, when the Fed moves rates, it has to create a winner and a loser, then I think this starts to make more sense, because the Fed has to take return or a risk from someone and give it to somebody else, because these rates are just what we're paying each other. They're not what we're paying out of the system. So another way to think of this is sort of by like process of elimination. So it intuitively makes sense that, if the Fed reduces the risk-free rate, which is the rate on bonds, it should benefit all bond substitutes to some degree. So for example, like it should benefit the debt that's issued by Apple or Apple stock even. But if we know that the Fed has to take from someone when it lowers rates, and we know that it's impossible to observe the prices of the riskiest activity, of the illiquid activity, and we know that it's, when the Fed lowers rates, it's raising the price of all assets that, we can observe the prices of, which is kind of all of the bond substitutes, then the only possible explanation is that it's actually taking value away from the activity that we can't see the prices of and bringing it towards the bond and bond substitute activity, which in turn means that, lowering the rate on risk-free assets actually increases the required return or cost of capital on risky assets. So we can actually see this in real time, even if we were to just use liquid securities. So historically, you can see here the red line is the 10-year treasury yield, and the blue line is the kind of corporate bond spread over that yield. So typically, the risk-free rate moves in opposite directions with the risky spread. And this makes sense because, for example, when growth is rising, you would expect both risk-free rates to rise and the risky spreads to fall as, risky borrowers become more creditworthy. And that's the first point I have here. But I'm actually making the second point here as well, which is that the increase in the risk-free rate itself contributes to a compressing of the risky spread. Because if we treat risky bonds as being supported by or sort of backed up by risk-free bonds, in the sense that there's some complementarity between risk-free bonds and risky bonds, then if you make risk-free bonds more of a viable asset by lowering their price and raising their yield, you actually make risky bonds more of a viable asset as well. So to kind of explain this, here if we kind of zoom into the recent period as an example, and now the blue line represents the risk-free rate plus the risky spread, so like the overall corporate bond yield. The point here is that when the risk-free rate is high, like it is today, that takes the burden of providing the free lunch of diversification off of the shoulders of the risky borrowers and gives some of that burden to the risk-free borrowers. And conversely, when the risk-free rate is too low, not only does an investor or lender require the additional credit spread from a risky borrower, but because this investor doesn't have a good way to diversify that risk, that extra risk-adjusted return from diversification is now essentially passed on from the risk-free borrower to the risky borrower. So, if we look today, right here, the spread is compressed. And I'd argue that, the reason for that is that some of that burden of diversification has been removed from the risky borrower because now, the investor has a good way to diversify that risk. So, when risk-free rates are very low, like they were kind of right after COVID, the lender is telling the borrower, compensate me for your risk and the fact that I don't have any good hedges. But today the lender can just say, compensate me just for your risk, but I already have a good hedge, so I don't need that extra little compensation. So the point I'm making here is that it's actually easier for a risky borrower to borrow at 6% when the risk-free rate is 5% than it is for a risky borrower to borrow at 4% if the risk-free rate is 1%. And the reason for this is that as your spread against the risk-free rate rises, the market is essentially appraising you as increasingly risky, which lowers your access to credit. And the other point here is that, we should think of it in terms of like borrowers borrow not just in a vacuum, but they borrow against their assets. And if their assets are generally returning, around the risk-free rate, then it's not too hard to borrow slightly over what your assets are earning. But if your assets are earning way less than what you have to borrow at, then it becomes difficult to borrow. So going back to our seesaw of substitutes and complements, we can actually put all these asset classes on that seesaw in some form. And so I've sort of grouped them into three categories. So we have safe assets, which are government bonds, which are liquid and they don't have any credit risk. And then we have risk assets, which have credit risk, but they're still liquid. They still have an observable price and they can still be sold in the market for cash. And then we have risky assets, which is bank loans, which not only have credit risk, but they also don't have the ability to be, bought or sold easily in public markets. So from this perspective, it makes sense that, the risk-free rate is an input to the valuation of risk assets, where, when bond yields go up, the yield on other risk assets go up because, these assets are some degree of substitutes. And this is the idea of like there are bonds in the stocks. But the interesting thing here is that, when the risk-free rate goes up, the risky rate actually goes down. The required return on risky assets goes down, which means that there's short bonds in risky assets for the reasons that we just discussed. And so I'm not obviously saying, that the risk yield falls under the risk-free yield, but rather just that the yields of these two asset types move in opposite directions. And the seesaw is a good way to kind of visualize that. And we even see this with some of the stocks that you can kind of consider more bond complement than bond substitute, meaning stocks that are like closer to the risky asset side rather than the risk asset side. So like, in the 2010s, as bond yield kind of experienced this like secular decline, stocks that had, some degree of substitutability with bonds. So you can think of like, longer duration stocks like tech stocks, or stocks with, very stable cash flows like kind of consumer staple stocks. These companies, had very strong returns because there was a lot of bond in those stocks. But the stocks that were very risky, for example, like an emerging market, like commodity sensitive stock, those kinds of stocks had very poor returns or even negative returns throughout the 2010s because they arguably had short bonds in them as well, because their return profiles were actually complementary to bonds rather than substitutes. And in this period, the price of bonds was going up, so the price of bond complements would go down. So if we think about it, if bonds are a falling nominal growth asset and stocks are presumably a rising nominal growth asset, it doesn't make any sense that, higher prices of a falling nominal growth asset, i.e. bonds, should imply a higher price on a rising nominal growth asset like stocks, unless liquidity is falling, which would move all these assets together in the same direction. So this seesaw kind of explains what we see with asset prices in high inflation periods as well. So in like the 1970s, as an example, all liquid assets, so, stocks, bonds, corporate bonds, they all had very poor returns. And the reason for that is that the supply of risky assets, meaning bank loans, was increasing so dramatically because nominal growth expectations were so strong that it seemed silly to buy assets in the financial economy when the real economy looked so attractive. And so that's why, the 1970s not only had higher nominal growth than any other decade, but it also had higher real growth than any other decade since like the 1950s, because not only was the rate of production of new assets so robust, but the types of assets that were being produced skewed towards the kind of high risk, high productivity, risky assets like bank loans, rather than more safe and liquid assets like safe and risk assets. And so even though we couldn't directly observe the price of those risky assets, we could see this dynamic playing out in the form of the price of bonds and bond substitute assets starting to fall. And this also reveals the problem that I have with the sort of wealth effect as being used as like the primary determinant for cyclical dynamics, which is that in order for there to be a wealth effect, there must be a shortage of financial assets, which is inflating the remaining supply of assets. And if there's a shortage of assets, then there must be a shortage of money, because money is sort of just the liabilities that match those assets, which means that there cannot be strong nominal growth in an environment of high financial asset prices unless those high asset prices reflect high asset cash flows rather than high asset valuations. But high asset cash flows would also just mean that assets are cheap, they're not expensive. So in that sense, the wealth effect is actually evidence of falling nominal growth expectations. So this overall framework is sort of when we start to get to the idea that the Fed doesn't exist, which is that a true central bank would have the ability to kind of move the fulcrum of the seesaw itself and sort of play with aggregate risk and return. But the Fed itself only has access to one side of that seesaw, and it's effectively treating that side like it's the fulcrum. So I've shown that as like the Fed being this boot that is like stepping on the treasury yield. And so this approach to monetary policy has consistently not worked, which I'll get to shortly, because when you reduce the yield of some assets, you necessarily raise the yield of complementary assets because the burden of diversification gets passed on to those assets. And so when I talk about diversification, I'm talking about at an economy-wide balance sheet level, not that like every player has a diversified portfolio, such that, when the economy as a whole is diversified, it means that for every player that is vulnerable, there is another player that's protected, which means that the system as a whole is more resilient, and that makes contagion, less likely. And then when risk-free rates are too low, there end up not being that many players that are protected, which then puts the system more at risk. So this is sort of a visual representation of what the Fed either thinks it's doing with monetary policy, or what the Fed needs everybody else to think it's doing, which is that we should treat all assets as like built up on top of this risk-free rate, so that the Fed just moves the risk-free rate around, and that moves all assets around, and the Fed is just able to like hand the system a free lunch and reduce the cost of capital for all assets. But the Fed has never been able to do this, both historically and logically, and we'll get into some of that history shortly. So the core argument of the Fed does not exist, like I just said, is that kind of a real central bank has its hands on the fulcrum of the seesaw, whereas the Fed and also every other central bank has its hands on only one side of the seesaw. So the reason the Fed doesn't exist is because its ability to kind of mechanically shape economic outcomes in the way that it thinks it can, or that we think it can, doesn't actually exist. And here's where we add another wrinkle, which is that if the Fed were to be able to convince everybody that it did have its hands on the fulcrum, then it effectively would have its hands on the fulcrum. It would have that power. But the Fed has actually been able to only credibly convince the system of this from about 1981 to 2013. And we'll get into that history shortly. But a question that I like to come back to is that, if there was no Fed and we had a recession, what would happen to interest rates? And the answer is that interest rates, meaning the risk-free rate, would fall all by itself without the Fed, because there would be a rush into safe and liquid assets, and there would be a rush into cash, which I think begs the question of, is the Fed actually doing anything stimulative when it lowers rates that the market would already be lowering in, a recession? And I think the answer is no. In fact, by acting pro-cyclically, the Fed is just further depressing conditions. So now let's kind of work through the mechanics of why the fulcrum is in the middle and not with the Fed. So let's go back to our seesaw. So the core argument here is that, when the Fed reduces the risk-free rate, it reduces the cost of capital for risk-free substitutes, so like risk assets and safe assets, but it actually raises the cost of capital for risky illiquid assets. So sort of when the Fed is reducing the risk-free rate, what it's actually doing is it's creating a safe asset shortage. It's creating a shortage of safe and liquid assets. And a safe asset shortage is essentially when the return on safe assets is low, or the price of safe assets is high, which is definitionally, what the Fed is doing when it cuts rates or does QE, because it has the intent of, getting everybody out of these safe assets and into riskier assets. And the thing is, when you create a safe asset shortage, the problem is that you produce an incentive for borrowers to fulfill that extra demand for safe assets, because, the borrower doesn't care if the high prices on safe assets is coming from the market or the Fed. If I'm being incentivized to borrow from that spot on the risk curve, then that's where I'm going to go regardless. Which means that, if you have access to borrowing in these safer markets, by which I mean, the liquid markets where everybody can observe your price, then you end up moving out of risky avenues where people can't observe your price and into the safe avenues for borrowing. And this means that you leave the riskier borrowers that don't have access to those safer markets, you leave those riskier borrowers in the risky markets. So if you don't have access to, those liquid markets, then your cost of borrowing has effectively risen against the risk-free rate, which makes you, less able and less kind of willing to borrow. So on that second point, if we start with kind of the classic risk curve, the point here is that, when the Fed creates a safe asset shortage by raising the price of safe assets and making them more scarce, the result is that you actually steepen the risk curve, you don't flatten it, because all of that burden of diversification gets passed to you as the risky borrower, because the system has now no real good risk-free hedge. And because, the borrowers that were borrowing those risky markets now have an incentive to move down into the kind of safer markets, which leaves the riskiest borrowers in those risky markets. So here I've kind of depicted this as like a kink in the risk curve, where as soon as you get into the territory of bond complements, the cost of borrowing for those players reflects that lack of the diversification free lunch. And then because, now these players' borrowing costs are so much higher compared to what they're earning on their assets, a lot of that borrowing actually stops, which means that the remaining borrowing that's still going on is happening at lower interest rates. So a safe asset shortage actually results in a survivorship bias towards borrowers that still have remaining access to credit, which tend to be already the safer borrowers that borrow at lower rates. So the interesting thing here is that what's happening is that everybody who can move down the risk curve to fill the safe asset shortage does so, and then everyone who can't is now shut out of markets for credit. And the result of this is that it looks like the Fed's actions have flattened the risk curve, when what they've actually done is they've shortened the risk curve. So what's actually happened is that, when the Fed cuts rates and does QE, it actually produces a liquidity hole that borrowers from the higher up on the risk curve come down to fill. And that liquidity hole then shows up as less access to liquidity or less access to capital for the borrowers at the top of the risk curve that don't have the ability to come down the risk curve. And so just to kind of hit this point home, when we kind of consider markets where there's no observable price, these markets actually exhibit asymmetric information because the lenders don't know who the lemons are really, which makes them kind of more risk averse and causes them to raise their average required rate from lending in order to protect against those lemons. And that causes these kind of risky fringes of the market to start to fail to clear, which is that liquidity hole that the safe asset shortage produces. Because now the safe assets that are short in supply are no longer available to act as hedges against something going wrong in the risky markets. And that's how you get this kind of shortening of the risk curve where there's less activity overall. So as a result of all of this, contrary to kind of what we would think, the price of risk-free credit and the volume of risky credit are actually positively correlated, such that, when the red line, the price of credit is rising, the volume of risky credit, meaning like bank loans, is actually also rising. And this is what it looks like for the Fed to kind of shorten the risk curve rather than flatten it. So, to shorten the risk curve means that, you reduce the overall volume of credit that's being extended. And that's what rate cuts and QE actually do by creating a safe asset shortage. So the key thing here is that it's, kind of easy to dismiss what we see on a chart because, we don't have the counterfactual and we can just claim that monetary policy has like long and variable lags such that like a decline in credit volume was actually caused by like an increase in interest rates that happened 5 years ago or whatever. But I think that, the mechanics actually fit what we just plainly see on the chart very nicely. So we don't actually have to dismiss the empirical reality. So this idea that, a safe asset shortage results in a reduced volume of risky credit extended is actually kind of well documented. So Bernanke pointed to this phenomenon in his work on the Great Depression when he said that, the idea that low yields on safe liabilities signaled a sense of easy money is mistaken, where money was easy for a few safe borrowers, but difficult for everyone else. And then in the aftermath of the financial crisis, FOMC members were pointing to the same thing, where, lenders were effectively shutting out borrowers from the market because what was, acceptable as like a qualified borrower was effectively being constrained. So a key takeaway here is that the lack of credit creation isn't always just a problem of low demand for credit. It's also often a problem of low supply of credit for risky borrowers. And the reason that that supply is low is because now the Fed has created a shortage of safe assets, a shortage of safe borrowing and lending opportunities. So that's where the activity will flood towards. So you can think of the Fed as like creating a vacuum on a certain part of the risk curve, and then everything gets sucked into that part of the risk curve. And then the other piece of that safe asset shortage, which I just mentioned, is that if you have the ability to present yourself as a safe asset, now you have an added incentive to do so. So this is another quote from an FOMC meeting where Fisher was pointing to the fact that, the Fed cut rates and that supposedly made money cheap to encourage spending and investment. But instead, what was happening was that in this case, Texas Instruments was able to borrow effectively for free and then buy back its shares, which had a higher dividend yield, which means that the firm is effectively redoing its capital structure to be more risk averse because it's more based on debt rather than equity. So if you have a safe asset shortage, you create an incentive to behave in a safe manner so that you can get somebody to lend to you in place of the safe government bond that they would have lent to but no longer have access to. And if you're acting safer, then by definition, you're not as productive for economic activity. So the result of the safe asset shortage that the Fed creates by doing QE and by lowering rates is actually to steepen the risk curve because it causes borrowers that can move down the risk curve to move down the risk curve. And then the borrowers that can't move down to present themselves as safe assets are stuck at those higher borrowing costs where they don't feel as kind of able to borrow at. And then this ultimately just shortens the risk curve because that riskiest activity becomes untenable. So that riskiest activity kind of falls off the risk curve. So the way I like to think of this safe asset shortage is that if we treat government bonds as sort of like the insurance of the economy, because bonds are sort of like falling growth assets, then what the Fed does with QE and rate cuts is it's effectively forcing the system to sell off its insurance in hopes of freeing up that cash to go out and take risks, which I think is just a silly way to think about how the economy manages its balance sheet. So, we have Florida as an example where in Florida right now, the price of home insurance is rising. And what you're not seeing is, Floridians just getting rid of their home insurance instead just buying, more homes. What you're seeing is they're either just leaving the state or they're self-insuring, which basically means they bear the brunt of the cost in the event that their home, gets like destroyed by a hurricane. So the thing here is that when you remove insurance from the system, you don't create a system that's more risk taking. You create a system that's more at risk. And a system that's more at risk is a system that's less risk taking, which means that the ultimate outcome of making insurance expensive, in this case bonds, is just less economic activity. So if interest rates on safe assets would already be falling in a recession, and then rate cuts and QE just exacerbate or they just produce that shortage of insurance, then what the Fed needs to do in order to actually be counter cyclical is to prevent a safe asset shortage by making insurance abundant, such that this insurance doesn't take up as much space on the balance sheet, which the Fed can easily do by raising the yield on safe assets or by adding safe assets back into the system whenever those safe assets become scarce. And so that looks like rate hikes and QT, not rate cuts and QE. So that's kind of the idea that I'm showing here, which is that the risk-free yield is the system's safety net because it's the guaranteed return that you can get when all else goes wrong. And if you know that you can get an okay yield in the worst case scenario, then taking risk doesn't seem like a terrible idea. So if you're the Fed, what you want to be doing in a recession is raising rates to flatten the risk curve, which is what we've shown happens both mechanically and historically. And that would, doing that would make risky projects less untenable versus the risk-free rate, which would result in more overall borrowing. And here's where I think it becomes clear that monetary policy is, obviously ideological, just like everything else, because, the idea that we should cut rates in response to a crisis to kick people out of safe stuff into risky stuff, that's the same logic that, if people have too many freebies and benefits, then they'll just become complacent and reliant on those benefits instead of taking risk themselves. And there's just no really definitive evidence to support this idea, both in terms of fiscal policy or monetary policy. The way to get people to actually take risk is to increase the supply of insurance and increase the supply of safety, which makes risk taking, more tenable. And so if we go back to our complements example quickly, we can kind of see this in action because as you have more of asset A, you can actually have more of the complement asset B, not less, for a particular volatility constraint. And so the reason is that typically players aren't really bound by the amount of equity or the amount of cash on their balance sheet. But rather, they actually have access to leverage, which means that they're really just bound by some sort of like maximum acceptable loss or volatility constraint. You're only return maximizing if you're not using any leverage. But if you do have leverage, then theoretically you can achieve an infinite return. So what actually matters is how much risk you bear for that return. So the more of one asset you have, the more of kind of a complementary asset you can also have. And so if you want to get people to buy more of either asset, you should want to make that two asset complement as attractive as possible. So this is another way to visualize this idea, where if we have some safe assets and some risky assets, the Fed's idea is, let's reduce the supply of safe assets such that people will be kicked into risky assets, which is this kind of 20-80 model. But think about how much worse the risk-adjusted return of the 20-80 safe risky split is than the 50-50 split. So what actually happens when the Fed tries to do this is that both logically and historically, the system tries to kind of maintain its safe and risky asset split in order to maximize its risk-adjusted return, which means reducing the supply of risky assets or converting some of those risky assets into safe assets in order to make safe and risky assets match up. This is actually what caused the financial crisis because because there was a shortage of true risk-free assets, the system serviced that demand by creating assets that were supposedly just as safe, but were actually made up of increasingly risky assets that were ultimately just exposed. So, what the Fed needs to actually do is the bottom approach is this 80-80 split, which is make safe assets abundant by lowering the price of them, which would free up balance sheet space to go out and do risky things. And that would prevent the private sector from trying to present itself in a safe manner in order to make up that shortfall in risky assets or in safe assets. And this is also why I think the notion that when the long end rises, it's somehow like doing the work of tightening for the Fed. I think that's also kind of a silly idea because a high supply of safe assets, which is what a high yield on the long end indicates, that high supply of safe assets crowds in risky assets. It doesn't crowd out risky assets because it makes risky assets have more of a place in the economy's aggregate portfolio. And this discussion of safe asset shortages is why it's so clear how fiscal spending is inflationary, whereas you kind of have to do a little bit of, or I think a lot of mental gymnastics to get from rate cuts to improved economic conditions, because fiscal expansion and quote unquote dovish Fed policy are actually opposites in terms of what they do to the supply of safe assets. So when you increase the fiscal deficit, you alleviate the safe asset shortage, but when you do rate cuts or when you do QE, you intensify the safe asset shortage. And we can think of safe assets as sort of the bedrock collateral of the system. So only one of these outcomes for safe assets can be inflationary, and it's very obvious that it's expanding the supply of that safe asset. So now we dive into some of the history of how we got to this position, where the Fed essentially has its policy tools backwards, and why the Fed doesn't exist in any mechanical sense. And to do this, we have to go back to Volcker, who I'd argue is actually the greatest central banker of all time, because he was the one who put the central bank on, front and center at a time when no one was putting the Fed front and center. So prior to the Volcker era, the Fed didn't exist because the system effectively didn't care about the Fed, because the Fed was sort of off doing its own thing that didn't really have much to do in terms of affecting the economy. So in this pre-Volcker era period, the Fed was primarily preoccupied with setting reserve levels in order to influence monetary aggregates rather than interest rate policy. And they explicitly acknowledged that they weren't trying to influence interest rates. And the problem was for them that moving around the supply of reserves didn't actually have a clear effect on either interest rates or economic conditions. And that actually applies today, where reserve levels and money supply levels have nothing to do with economic activity. And I described this in the reserves chapter. And I think these three quotes kind of convey that. So in these three quotes, Volcker makes three admissions. First, that the Fed was effectively allowing the Fed funds rate to float by constantly adjusting the band to allow it to go wherever it wanted to go. And then in the second quote, that there was no clearly, identifiable relationship between the money supply and the Fed funds rate. And then finally, in the last quote, that there was no relationship between the money supply and the economy. So if the Fed is spending all of its time managing the money supply, and the money supply has no influence on the Fed funds rate or on economic outcomes, and the Fed funds rate is floating, then there isn't really a Fed that's actually doing anything mechanically to affect the economy. And that's why pre sort of 1981, the Fed did not exist. And I go into much more depth on these in the chapter of Volcker, and also, why money supply was irrelevant in that chapter. So now, by the late 1970s and early 1980s, the Fed was in this predicament where they were basically forced to realize that they had almost no ability to control economic outcomes, which is a problem because their mandate was to do exactly that. So, if the Fed was tasked with steering the economy, but they didn't have a steering wheel, then what Volcker's key contribution to the Fed was to invent a steering wheel to create the appearance that the Fed was steering the economy. And we can actually see this pretty clearly in this Corrigan quote, where Corrigan admits that the Fed funds rate is the only thing we have in the short run that is fairly unambiguous because money supply and reserves are all over the lot. So we need to get the markets and everybody else to recognize the role that the Fed funds rate plays, which to me suggests that prior to the Volcker era, the system didn't really care about either the Fed funds rate or the money supply. And then a couple months later, this another FOMC member, Larry Roos, he follows that up by making the point that the goal should be to impose the discipline of monetary policy on the banks, i.e., teach them a lesson that you have to take what we're doing seriously, which again to me suggests that banks prior to the Volcker era weren't taking the Fed that seriously, and I think justifiably so. But slowly, basically by the 1980s, early 1980s, the Fed begins moving in a direction where rather than manage some sort of mechanical policy lever like money supply, monetary policy is now becoming one of just effectively imposing the Fed's will, in which the Fed basically just declares, the economy shall be strong or the economy shall be weak, and hopefully get the players in the economy to kind of carry out that vision just because the Fed said so. And in this idea, kind of in my view, is the crux of why interest rates experienced a secular decline since Volcker supposedly caused a recession by hiking rates a lot, which he didn't, and I get into that in the book as well. The main thing is that he didn't cause the recession via interest rates, but rather he attached the recession to his rates to create the appearance of rates driving the economy. But prior to that point, the Fed was widely acknowledged by banks and other kind of actors as mostly irrelevant to conditions. And whenever there was a recession, rates would fall, reflecting conditions getting tighter. And then when the economy is picking up, rates would rise, reflecting conditions getting easier. And Volcker himself made this point in 1980 that, interest rates went up, which would suggest that your policy has gotten easier. And then when Volcker flipped this interpretation of interest rates in 1982, he flipped it towards one where falling rates now supposedly reflected policy getting easier rather than tighter, which meant that now effectively we have a Fed that's mechanically acting pro-cyclically rather than counter-cyclically, which means that obviously if everybody believes that lower interest rates are better and that we need lower interest rates to stimulate the economy, then eventually interest rates will obviously fall towards zero because everybody's working together to make that happen. And that's why in this chart I have easing and tightening in quotes after the Volcker era. because a fall in interest rates isn't actually an easing, it's a tightening. Because when the demand for safe and liquid assets is rising, it must mean that the real economy is doing worse and that money is getting less easy to access for risky players or the private sector. The other point here is that because the interpretation of what the Fed is doing and what market prices are showing is constantly changing, trading markets in a way that uses an understanding of the Fed or other central banks that is supposedly universal and timeless is always going to run into problems, because the reality is that the way that the Fed interacts with the system and whether or not the system even cares about the Fed is very unstable and is always changing. So this view of things obviously is kind of in contrast to the general idea that, what caused the secular decline in interest rates over the last 40 years was a bunch of like disinflationary forces like globalization and aging demographics and technology. And I have technology in quotes, which I'll explain in a second, where, all these things caused disinflation, which then allowed the Fed to keep rates lower. My view is actually that, these things don't just come out of nowhere, but they're rather a natural response to the distribution of availability of money for the system. And what I mean by that is that it's actually the secular decline in interest rates produced by the Fed that had its policy tools backwards, which caused secular disinflation by producing a safe asset shortage, because that safe asset shortage produced a risky asset shortage, which means that there was an overall asset shortage, which meant that there was a money shortage. And it's this money shortage that then produced an incentive to find cheaper labor. And it's the money shortage that produced an incentive to have fewer kids in the developed world. So on the technology point, it's easy to say that all the technology and digital revolutions that we've had over the last 40 years are what kind of produced that significant disinflation. But I'd actually argue that it was disinflation that produced a skew towards certain kinds of technologies that matched that disinflationary environment. Meaning that if there's a money shortage, let's create technologies that can deal with that money shortage effectively. And it's also incorrect to just say low rates are what facilitated those technological advances. Because if we just look at real growth and productivity, the period from 1950 to 1985 actually had higher total real growth and productivity growth than from 1985 to 2020, which means that we were advancing faster as a country or civilization when rates were high than when rates were low. So just to put some numbers on it, from 1950 to 1985, real GDP increased 250% and productivity increased 115%. And then from 1985 to 2020, real GDP increased only 150% and productivity only increased 93%. So sort of putting all this together, the Fed does not exist as we think it does, because the Fed only really has two policy levers. Either it can stimulate by reducing the price of safe assets, which would give the system the free lunch of diversification, or it can stimulate by sort of convincing the system that by cutting rates, it's somehow stimulating, which would essentially trick everyone into acting as if everything is okay, because now the Fed is coming to the rescue, which would allow the system to carry out the Fed's will in this sort of like self-fulfilling prophecy. And the sort of unfortunate thing is that in 1981, the Fed decided to go with the second option, when what it could have done and what it should have done was to just convince everyone instead that rate hikes were stimulative, which would then allow the psychological lever to match the mechanical lever. And a fun fact here is that in 1982, in order to kind of get the psychological lever out there, Volcker actually commissioned a radio journalist named Robert Krulwich to record an opera called Ratto Interesso, in which he explained how lowering interest rates somehow stimulated the economy. So the really unfortunate thing is that all the Fed really needed to do was just record that opera, but instead explain how raising rates stimulated the economy, and then monetary policy would be really clean and easy. Because instead right now we're in this world where like high inflation means bond yields should be high, but then high bond yields are supposed to act against inflation, but also inflation is supposed to be self-reinforcing. So the Fed is basically using its tools in a way that isn't consistent with the price signal that its tools naturally send. And so the way that I kind of reconcile this is that we're basically in a situation where the Fed is playing this form of like red light, green light with the economy, where the Fed is using the short-term interest rate as their signal for the game, such that whenever the kind of interest rate is falling, that's a signal that the Fed is telling everyone, go do stuff in the real economy, we're helping out. And then when the interest rate is rising, that's the Fed telling everyone, stop doing stuff because the things need to cool down. And unfortunately, the mechanics just work against those intentions, which is why I think the linkages between monetary policy and economic conditions are so opaque, and they require long and variable lags to hide behind for why things don't seem to be, always working as they should. So the takeaway from this is that from the mechanical approach, if Volcker wanted to end inflation in 1980, what he should have just done was bring rates to zero, not 15%, 20%. And similarly, if Powell today wanted to end inflation, he should have kept interest rates at 0%. So inflation today was actually always transitory until the Fed started raising rates in an attempt to deal with it. But the red light, green light game called for Powell to start raising rates. So that's what he did. And now it's possible that we're entering a kind of secularly inflationary dynamic because the Fed has started raising interest rates again. And so if we fast forward kind of 28 years later into the QE era, it's clear that all the zero lower bound really represented was the Fed's signal of choice for the red light green light game, which was interest rates. That choice simply burnt out, and now the Fed needs a new signal to keep the game going. And so the one that it found, because it doesn't actually have that many tools, was to do this QE as a form of like so-called money printing. Even though I think it's ridiculous to call it QE money printing, and I go into this more in the QE chapter. But I would consider QE more like money transforming, and transforming in a way that results in less money being printed by the actors who actually have the ability to print money. Because all QE really does is swap one asset with a different asset. Whereas when you print money, you take a piece of paper and you give it new value, which is not what QE is doing. So if we look at kind of how QE was being discussed in these FOMC meetings, it's very obvious that QE was mostly seen as like a tool that could help the Fed communicate that they're doing whatever it takes and providing shock therapy to the system, rather than like an actual mechanical linkage between replacing bonds with bank reserves and that somehow like reflating the economy. So here Dudley is saying that I think it's very important in our communications that we don't signal we're out of ammunition. And then in the next quote, Lockhart makes the point, which that QE works in practice, but will it work in theory? Which is that exact idea that it works just because people believe it works, but we don't actually know how QE is doing something to like mechanically reflate the economy. And in that quote, he also says, I doubt that balance sheet tools will have much real effect through the credit channel, but through psyops, QE is a powerful shock therapy. And then similarly, in this last quote, Yellen says that QE would clearly convey that we are determined that we will do whatever it takes. So I think this is kind of indicative of the idea that QE was just step 2 in the Fed's red light, green light game, rather than like a new mechanical policy that actually adds assets to the system, which it doesn't do. So the Fed existed from 1981 to about 2013 because that was the period when the system believed that the Fed had access to the fulcrum of the seesaw and was effectively moving it around. But the financial crisis in like 2009 posed a serious threat to that paradigm, in which the Fed was perceived as having a mechanical lever. And so around 2010, the Fed gave it one last shot to maintain that illusion using QE, which it actually initially did work. It produced these like transitory periods of expectations rising that things would improve and people believing that the Fed is doing everything it can to help out. But I think this faith in the Fed actually ended around 2014 after the taper announcement, which was ultimately reversed. But again, the interpretation of the taper should not be that the Fed, indicated it would start tightening, which caused bond yields to rise as a reflection of that tightening, but rather that the rise in yields was the market cheering on the end of the bond buying because, the market believed the Fed when the Fed said that conditions were strong enough to no longer warrant our quote unquote easing. And the rise in the bond yields was a celebration of this because we should want a world with high real yields because that means that people are getting paid to create new money. And unfortunately, that celebration turned out to be short-lived because by like 2015, there was again mounting risks of a downturn. There was more QE in the pipeline, and everybody was kind of recognizing that the Fed was just wholly unable to credibly reach its inflation target. And since then, the Fed's mechanical policy levers have effectively all been broken. So in a situation where the mechanical policy levers are broken, the Fed kind of recognized this and they explicitly, expressed a move to a model of policymaking where their communication effectively became the policy. So instead of the Fed, playing the red light, green light game by setting an interest rate and that doing the signaling as it had for kind of 30 years, now the Fed was in this zero interest rate paradigm of forward guidance where all of the policymaking had to come from their communication. And you can see this reflected in these quotes where Yellen describes monetary policy as like now explanation is the policy. And what happens to the Fed funds is relatively unimportant, but how the public expects the Fed will want to influence conditions is important. And then this quote by another FOMC member where he's reflecting on how the markets, aren't understanding what message the Fed is trying to send with their interest rate policy. He says, the markets are interpreting the fact that rates will stay low for a while as an indication that the economy will remain weak for a while, which is the wrong takeaway from us keeping rates at zero. We need to convince everybody that, we're actually saying that the burden for how strong the economy needs to be in order for us to raise rates is actually quite high. So the key thing to recognize here is that the financial system is always evolving to kind of skirt regulations and government, just like any other industry. So the Fed will always keep becoming secondary to what's really going on, which is why the Fed doesn't exist, because there's no entity that can independently manage the economy as long as the economy keeps evolving to invalidate those mechanical policy levers. So if we apply this to kind of a typical business cycle, the left side is sort of how the Fed wants us to think the cycle works, where the Fed raises rates and that puts pressure on everybody, which causes demand to slow kind of uniformly until the Fed cuts rates and lifts everybody back up. And the reality is that when the Fed raises rates, it's the right side that the change in the rate paradigm creates an equal and opposite set of winners and losers, which means that in cumulative terms, nothing has really changed in terms of like the aggregate risk adjusted return of the system. But what has changed is that now the Fed is sending the red light signal that everybody, needs to stop or else. And then also that when you change that set of winners and losers, you create vulnerabilities in forms of frictions as the economy is forced to sort of adjust its balance sheet to fit this new higher rate paradigm. And if it just so happens that, this adjustment affects the systemic player, then you get a contagion that ultimately does make everybody, losers. So effectively, when the Fed changes rates in either direction, all it's doing is adding risk in the form of volatility through those balance sheet frictions, which reduces the system's overall risk-adjusted return, which is why as soon as the Fed assumed control of interest rates in the early 1980s, we began this downward trend in interest rates, which reflected that the risk-adjusted return potential of the system was falling. So like I said earlier, the secular decline in interest rates was the Fed's own doing because they decided to become in charge of interest rates and introduce a new source of volatility into the system. And so this decline in interest rates should not be welcomed or celebrated, but rather we should lament it because it means that the system is no longer productive enough to sustain those high rates and it's unwilling to produce assets at a high rate. And we have the Fed to thank for that. So the point here is that the Fed doesn't create recessions from a particular level of rates, but from the size of the shock, both psychologically and through these balance sheet frictions that it can deliver to the system in the form of added volatility, which just raises the likelihood of getting like a left tail event. And so to take this to this conclusion, I would actually argue that, if the red light, green light effect of interest rates didn't exist, then cutting interest rates with the same amount of speed as raising interest rates would be just as effective at producing a recession, if not more, because it would force balance sheets to adjust to a world with less ability to diversify and one where the winners are skewed towards the safer players and losers are skewed towards the riskier players. And it's just, that this kind of rate obviously only happens in the midst of a recession, so we don't have any examples to test this. But changing rates in either direction introduces just enough volatility to raise the likelihood of a tail outcome. If we compare that to fiscal policy, it's very obvious why the linkages for fiscal policy are so clear cut. So when the fiscal deficit expands, the supply of safe assets rises, which gives risky assets a complementary asset to attach to. And in terms of our seesaw, that looks like raising the safe side, the left side, to give back return to the risky side. And that's all there is to fiscal policy, which is why it's so clearly reflationary when the fiscal side is expanding a lot, unlike monetary policy. So if we think about how monetary and fiscal policy interact, the interesting thing here is that over the last 3 years, the fiscal spending of Bidenomics is actually the third most stimulative policy to occur. So in second place was Bidenomics, but instead of financing it with safe assets that pay 1% or 0%, now we're financing it with safe assets that pay 5%, which means that there's effectively a huge safe asset abundance that the rate hikes produced. And the private sector is now well equipped to either borrow more or keep spending at high rates because the supply of those assets is so abundant. And that shows up as more savings and more collateral for the private sector. And I think the slowdown in credit that we've seen recently is more of a function of the fact that rate volatility has risen a lot, which kind of goes with the fact that one, rates have changed, and two, the Fed is playing the red light, green light game where banks kind of feel psychologically like chilled from lending. Because if we go back to the Roos quote where he said, we need to impose the discipline of monetary policy, but there's nothing intrinsically about higher rates that should make lending conditions tighter, because higher rates just mean everybody's getting paid more. And empirically, that's what you've seen through history. And then in first place, it would be all of that, but with the Fed not only raising rates to alleviate the safe asset shortage, but to do quantitative tightening and add even more safe assets to the system, which has the effect of replacing these useless bank reserves that the Fed has created, which I get into more depth in the book, with treasuries that have vastly more utility as safe assets and that are accessible to all market participants. So this combination of fiscal spending, rate hikes, and QT is effectively plugging the liquidity hole by giving the system a set of good assets to sort of build on top of. And yes, that does mean that, it may deflate some of the safe asset substitutes like corporate bonds or even safer stocks. And we've kind of seen this with bear markets in certain markets, like sort of like unprofitable tech companies in 2022, for example. But then that's actually part of the process for entering a true inflationary dynamic where liquid assets underperform, but that's because the real economy, illiquid assets are outperforming. So hopefully we're out of the ZERP era, and that's not just because ZERP reflects that conditions are, deflationary and very poor, but also because the ZERP era helped bring us deflation and stagnation and deleveraging, along with a host of other problems like, unproductive debt and worsening demographics. And unfortunately, the concern is that if there is another recessionary event and the Fed feels like it has to do whatever it takes, then the Fed will just reopen the ZERP grave that it got the economy out of recently and dump the economy back into it. So the final kind of overarching point is that we have to separate between what the Fed intends to do and what its linkages mechanically do, and recognize that to trade what the Fed is actually doing is what macro is, and to trade what the Fed intends to do or what the Fed is trying to do is what sentiment trading is. And the best example I think of how these diverge is the idea that there would be like a recession in 2023, either in the real economy or through sort of like corporate profits, just because all of a sudden that's what the Fed has implicitly indicated that it wanted to do. And the reality is that the Fed has been using its tools unknowingly to stimulate, and as a result, we've gotten a set of very strong kind of real growth prints instead of a recession. And I'd argue that now the Fed is keeping rates at high levels and not moving them around, which is making the economy kind of stronger than it's been in a long time. And so what the Fed has been saying has been no match for what the Fed is mechanically actually doing, especially because the system is increasingly recognizing that talk is kind of cheap and ineffective. And as a result, I think in the current paradigm, the Fed pretty clearly does not exist.